Hello and welcome! Today we're going to unpack the single most important concept in all of finance. Seriously, it's called the time value of money. And here's the thing, if you can really get your head around this one idea, you'll have the key to understanding how pretty much every financial asset is valued. So, let's get right into it. It all starts with a question that's so simple it almost feels silly. Would you rather I give you $100 right now, or that same $100 a year from now? I mean, the answer is obvious, right? You'd take the money today. But the real question is, why? That why is the key to everything we're talking about today.
And that why is the time value of money. It's this fundamental idea that money you have today is worth more than the exact same amount of money in the future. And it's all because of its potential earning capacity. You could take that $100 today and invest it, right? It could be earning interest, growing, and becoming more than $100 by next year. Money has potential, and that potential itself has a value.
Okay, so let's really break down this golden rule. How do we actually put a number on the value of time when we're talking about money? Well, it all comes down to one crucial thing, the interest rate. You know, an interest rate isn't just one single thing. You can look at it from a few different angles. For an investor, it's the required rate of return, the absolute minimum they need to earn to be willing to part with their cash. For a financial analyst, it's the discount rate, the tool they use to pull future money back into the present. And for all of us, it's the opportunity cost. It's what you give up by spending money today instead of letting it grow. Three different names, but they're all just different ways of describing the price of using money over time.
So how do we actually use this in the real world? Let's start with something nice and simple, valuing a promise. And in the world of finance, one of the most straightforward promises you can find is a bond.
The magic really happens with this formula. Now, I know it might look a little intense, but the idea behind it is actually super simple. To figure out the present value, the PV, of some money you're getting in the future, you just take that future value, the FV, and you shrink it. By how much? Well, you divide it by 1 plus the interest rate, R, and you do that for every single time period, T, that you have to wait. That whole process is called discounting, and it's basically financial time travel. It lets us figure out what a promise for future money is actually worth to us right here, right now.
Let's put some real numbers to this to see how it works. Imagine you have a simple bond that promises to pay you $1,000 in 5 years. And let's say your required return, that discount rate, is 5%. We just plug those numbers into our formula. What do we get? That promise of $1,000 in the future is only worth $783.53 to you today. That huge difference? That's the time value of money right there in action. So, valuing a bond is pretty straightforward, right? Because the payments are fixed, it's like valuing a very clear promise. But what happens when the future is, well, a lot less certain? That brings us to a whole different ballgame: stocks.
So this is where we level up. We're going to take that exact same golden rule of the time value of money and adapt it for the wild, uncertain world of stocks. See, unlike a bond with its clear promises and end date, a stock is a piece of a company with a future that's, well, hopefully growing, but definitely uncertain. The main principle is exactly the same, though. A stock's value today is just the present value of all the cash you expect to get from it in the future, like dividends. But here's the big catch. We don't know for sure what those future cash flows will be, so we have to add another layer to our thinking. We have to estimate how fast those cash flows are going to grow.
Okay, this is where it gets really cool. Up until now, we've been using our own assumptions about the future to try and figure out a price. But what if we flip that whole idea on its head? What if we use the price that's already out there to figure out what the market is thinking about the future?
Just think about it for a second. We know the price of a stock or a bond because we can just look it up. So if we already have the present value, the price, and we know the future value, we can work backwards and solve for that missing piece of the puzzle, the interest rate, R. For a bond, this is called the yield to maturity, and it's the total return the market is implying you'll get. And we can do this exact same thing for stocks.
What we're doing here has a name. We're calculating the implied return or the implied growth rate. It's like a form of financial archaeology. We're taking the price that everyone has already agreed on, and we're digging into it, working backwards, to uncover the hidden expectations about the future that are baked right into that price.
Let's use a real company that we all know, Coca-Cola. We can rearrange our valuation formula to solve for that missing growth rate, G. We know the current stock price. That's our present value. Let's say it's 63 bucks. We know the company is expected to pay a dividend of about $1.76. And if we assume that investors, for a stable company like Coke, require an 8% return, well, now we can solve for the one missing piece of the puzzle. What growth rate is the market actually pricing in?
The answer comes out to about 5.2%. Now, this isn't just some random number. This is the perpetual growth rate for Coca-Cola's dividends that is implied by its current stock price. In other words, the market, in its collective wisdom, is basically saying, we believe Coke can grow its dividend by 5.2% a year, forever. And if you, as an investor, think they can grow faster than that, well, then the stock might just be a bargain.
So you see how powerful this is? We've used one single, universal principle, the time value of money, to make sense of both the clear, certain promises of bonds and the much more fuzzy, uncertain future of stocks. It's truly the one principle to value them all. So what are the big things to remember here? First, that golden rule. $1 today is always worth more than $1 tomorrow. Second, the act of valuing something is really just about pulling all of its expected future cash back to today. Third, this one idea works for everything, from simple bonds to complex stocks. And finally, and maybe most importantly, prices aren't just numbers. They are stories about the future, absolutely packed with the market's hidden expectations. And that leaves us with one final thought. Every time you look at a stock ticker or a bond yield, you're not just seeing what it's worth today. You're actually seeing a forecast, a collective bet on the future. So the next time you look at the market, ask yourself, what story is it trying to tell me about tomorrow?